Advanced liability-driven investment strategies extend beyond traditional immunization and cash flow matching by incorporating derivatives and dynamic portfolio management techniques. These approaches are designed to improve flexibility, enhance capital efficiency, and maintain alignment between assets and liabilities under changing market conditions. Common advanced strategies include contingent immunization, derivatives overlays, and duration adjustment programs using futures and swaps. Rather than relying solely on physical bond holdings, managers can modify interest rate exposure quickly through derivative instruments. These techniques allow institutions to preserve liquidity, reduce transaction costs, and respond efficiently to evolving liability structures. The ultimate objective remains the same: ensuring that future obligations can be met while prudently managing risk and funding status. Contingent immunization is a hybrid strategy that combines active management with liability protection. The institution begins with assets that exceed the amount required to immunize liabilities, creating a surplus that can be actively managed in pursuit of additional returns. As long as the surplus remains above a predetermined safety threshold, managers are permitted to take active investment positions. However, if adverse market movements reduce the surplus to the critical level, the portfolio immediately transitions to a fully immunized structure. This strategy offers an attractive balance between return enhancement and liability protection. Success depends on disciplined monitoring of funding status and timely execution of the immunization process before the institution's ability to meet obligations becomes compromised. Derivatives overlays provide another powerful tool for managing liabilities and duration gaps. Interest rate futures, swaps, and other derivative instruments allow managers to alter portfolio duration without significantly changing underlying asset holdings. For example, receive-fixed swaps increase portfolio duration, while pay-fixed swaps reduce it. Futures contracts can efficiently modify interest rate sensitivity and maintain desired hedge ratios. Because derivatives require less capital than cash bond transactions, they improve implementation efficiency and preserve portfolio liquidity. Overlay strategies are particularly useful when liabilities change rapidly or when market conditions require prompt adjustments. However, successful implementation requires careful monitoring of hedge effectiveness, collateral requirements, and counterparty exposures. Despite their benefits, liability-driven strategies are exposed to several important risks. One major limitation is that duration-based hedging relies on assumptions and approximations. Duration measures sensitivity to small interest rate changes and generally assumes parallel shifts in the yield curve. In reality, yield curves often experience twists, steepenings, flattenings, and other non-parallel movements. Such changes can create structural risk because assets and liabilities may respond differently than expected. Convexity differences can further reduce hedge effectiveness. Consequently, managers must recognize that matching duration alone does not guarantee perfect liability protection and should supplement duration analysis with broader risk management techniques. Model risk also represents a significant challenge in liability-driven investing. Complex liabilities, particularly those associated with defined benefit pension plans or insurance obligations, require numerous assumptions regarding discount rates, cash flow timing, mortality, inflation, and participant behavior. Errors in these assumptions can lead to inaccurate liability valuations and ineffective hedging strategies. Measurement risk may also arise when managers rely on weighted average portfolio characteristics rather than more comprehensive analytical techniques. Additionally, derivative-based hedging programs depend on assumptions regarding futures pricing, cheapest-to-deliver bonds, and other market variables. Inaccurate modeling can cause substantial deviations between expected and actual outcomes, reducing the effectiveness of liability management programs. Additional risks arise from spread movements, liquidity constraints, and derivative exposures. Spread risk occurs when asset yields and liability discount rates do not move together, causing changes in funding status even when duration is matched. Asset liquidity risk emerges when securities cannot be traded efficiently near fair value, limiting a manager's ability to rebalance positions. Derivative strategies introduce collateral and cash flow risks because gains and losses may require immediate settlement or margin payments. Over-the-counter derivatives can also create counterparty risk. These factors highlight the importance of comprehensive risk assessment and diversification when implementing liability-driven investment programs designed to meet long-term obligations. Topic shifts attention to index-based investing in fixed-income markets. Bond index portfolios seek to replicate benchmark performance while minimizing tracking error. However, Fixed income indexing presents unique challenges compared with equity indexing. Bond markets contain a far larger number of securities with varying maturities, coupons, credit qualities, and embedded options. Many bonds trade infrequently, and liquidity conditions vary significantly across issues. Full replication is often impractical because of the large number of constituents and associated transaction costs. As a result, managers typically employ sampling and optimization techniques designed to replicate the benchmark's key risk characteristics rather than purchasing every bond in the index. Successful fixed income index management requires matching the benchmark's primary risk exposures while controlling tracking error. Managers seek to align modified duration, effective duration, key rate durations, sector allocations, issuer concentrations, and credit quality exposures with those of the benchmark. Cell matching is frequently used to replicate important characteristics without owning every security. Passive exposure can be obtained through separately managed accounts, index mutual funds, exchange-traded funds, or synthetic strategies such as total return swaps. Benchmark selection remains critical because bond indexes evolve over time as securities mature and new issues enter the market.